money supply, not just the increase in consumer goods, because the CPI is a distorted, it's a sub-metric, right? If you look at the US dollar, the supply of dollars has been increasing 7% a year for 90 years. It's been increasing 15 to 20% a year for the past 2 years.
Whoa.
Right. Right. So the big
idea. I
think
that's true. So it seems worth walk us through where do you get that number?
Well, if you go back to 1930, my house in Miami Beach cost $100,000. And if you roll the clock forward to 2012, it cost $14 million. And today it would cost you $40 million. So it's 400 times more expensive than it was, 92 years ago. Now, if you back solve that, you'll find that works out to about a 6% or 7% annualized inflation rate. Right. And if you go and you look at any kind of scarce, desirable asset, something that is you can't make any more of, you'll find typically they increase in cost about 7% a year normally. You can actually see if you look at the market basket of things people want, like really good healthcare, really good education, a beach house in the Hamptons, artwork, Picasso's, right? That kind of stuff. That doesn't go up in price 1 or 2% a year. That goes up in price normally about 7% a year. And if you look at the price of a basket of stocks, like the S&P has gone up about 10% a year. Well, the reason it's gone up 10% a year is because the money supply expanded at 7% a year, and then the underlying companies probably grew 2 or 3%, effectively. So you can figure this out for yourself if you just start to go and take samples of what stuff cost in 1971, what it cost in 1930, what it cost in the year 1950. And what you'll see is that for anything that's really desirable, like scarce energy that has energy content, it doesn't go up in price 2%. Now, the stuff that doesn't go up in price as expensive is stuff that's highly manufactured with low energy content, high information content. So, for example, a streaming video on YouTube, or something that could be stamped out in quantity 100 million at a time. Boxed food, right? Stuff, highly manufactured stuff that has machines generating it, or even better, something that's got cheaper, right? It costs a lot of money to listen to Beethoven's Fifth Symphony if the orchestra plays it in 1850. But it costs not that much to listen to Beethoven's Fifth Symphony if you're listening on your iPhone through your AirPods, right? So if I can strip the matter and the energy out of the product, I can provide that to you very cheaply. So the information content products got cheap, but steaks, right? More expensive, although there's a slight benefit. If you can manufacture 100,000 cows and I can use machines, right? Then that's a deflationary thing. One thing you can't easily manufacture more of is 3 acres of beachfront property in the Hamptons. That's very difficult, right? And if you look at the cost of a Palm Beach house, they're $100 million right now. Okay, so $100 million for a house on 2 acres or 3 acres in Palm Beach. Now ask yourself the question, why isn't that getting cheaper? That thing's going up a lot. So the problem, coming back to money, is fiat currencies aren't anchored in energy. When we were on the gold standard, theoretically, during the gold age, 1870 to 1914, if a dollar was convertible in a 20th ounce of gold, right, and you really pegged it hard to gold, then you're anchoring the currency into a hard asset. Now, gold isn't fixed in supply. The gold supply increases at 2% a year, 2 to 3% a year. So if you're on the gold standard, that means that the supply of money would be increasing at 2% a year, or otherwise doubling every 35 years. So money under the gold standard, perfectly executed, bleeds energy every 35 years. It's got a half-life of 35 years. But that creates stable prices, Tom, because the economy grows at 2 to 3% a year. So if the economy grows 3% a year, if the money loses 3% of its value a year, then everything kind of stays stable, right? The demand increases, the supply increases, right? That's a good situation. In that case, you can save your money, and 30 years from now, your money will be worth as much as it is today. Now, if it turns out that you're saving your money and the supply of money is increasing at 7% a year, then the money is cut in half every 10 years, right? And so that means in 30 years, the amount of money you have will be cut in half once, twice, 3 times. So you would have 12.5% of your wealth in 30 years saving money under the fiat standard, under a 7% regime. Now, 7% was about the rate that the US was inflating the dollar supply. But in the developing world, in weaker countries, you would see them inflate the money supply about double that, 14%. So the half-life of their money is 5 years. The half-life of the dollar is 10 years. Most people don't even notice 10 years as half-life, except that anecdotally, if you asked anybody in the past 20 years, are you going to save your life savings in a checking account that earns